Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, the market's volatility does not appear to be wanting to go away as we deal with really one of the largest two-day Dow rallies we've ever seen. The Dow was up around 1,500 points 2 days in a row, so that's good news. Let's hope it continues. But today I want to talk about what a very reputable billionaire said about what he thinks the market will do in terms of performance over the next decade, and talk about why that is his position given his study of market history. So let's jump into that today, and we'll go over a little history lesson. And some of these things we'll talk about today, we've actually referenced in the past. So if you're a frequent watcher of the videos, you probably remember some of the things that we're going to talk about today. So who's the billionaire? His name is Stan Druckenmiller. So if you're following the financial markets, you're familiar with his story. Very reputable, track record. He's one of the folks that Wall Street looks to for his opinion. So he recently said that he has a position or a belief that there's a high probability that the stock market is going to be flat for the next decade. And he goes on to say that now they're like reformers, referring to the central banks, meaning the Federal Reserve. They've gone from printing a bunch of money, like driving a Porsche at 200 miles an hour, by not only taking the foot off the gas, but by slamming the brakes on, he added. And again, he's talking about how for years and years they were reducing interest rates, and obviously now they're focused on taming inflation and obviously raising interest rates. As a result, gains in the bullish stock market since 1982, which went into hyperdrive in the last decade, will likely taper off. He said, again, goes on to say, there's a high probability in my mind that the market at best is going to be kind of flat for 10 years, sort of like the 66 to 82 time period. Well, again, Stan Druckenmiller's study of bull and bear markets, for decades and decades would lead him to believe this. And I think it's important for, if you're in the financial markets, to understand and have some perspective where we are in the market cycle, what tends to happen after we get large run-ups, and what tends to happen following those run-ups. So let's jump into that. Again, you've seen me talk about this before, and I'm going to share with you the same data because I think it's important repeating. So here's a history of the S&P 500. As you know, the S&P 500 is the largest 500 stocks in the marketplace. So this is a chart going back to the 20s, and obviously we've had our bull and bear markets. What I want to focus on today is the period of time following a big market run-up. So starting here in the 20s, the mid to late 20s, you can see we had a very big bull run and a very long period of consolidation to down market. So from 1929 at the peak to 1947, the market, and of course, it's highlighted by the Great Depression, the market really went nowhere. So fast forward, let's look at 66 to 85. This is around the time period that Druckenmiller was referring to. Again, after 47 to 66, in that time period, we had another big run up. And then following that run up, we had a go nowhere market. Notice the consistency here. Again, from 85 to 2000, we all remember the dot-com bust, let's call it from 95 to 2000, or let's call it around 99. The market just took off with a lot of dot-com companies just going berserk on, in terms of valuation. And then from 2000 to 2013, we had that very famed time period called the lost decade. So again, notice the pattern. When the market had a big run-up, for some years, we tend to have a go nowhere market for a period of, could be 5, 10, 15 years. So this is Druckenmiller's position. Again, his study of bull markets and what happens after you have a very long bull market run, his study would lead him to believe that, again, if the past gives us any clues to what may happen in the future, his position is we likely will get the same result where the market effectively goes nowhere. So again, the nice thing, though, he says, is there were companies that did very, very well in that environment back then. So, for example, and again, his time period of, let's call it the 80s and late 70s. That's when Apple Computer was founded and Home Depot was founded. So it's not as if, let's assume he's right, and the next 10 years are going to be like the other periods of, after the bull run. There still will be opportunities. Now, what are those opportunities? It's anyone's educated guess. But again, if you buy and hold, at least per Stan Druckenmiller's position, you're buy and hold equities, you're very likely going to get meager returns. And even with dividends, you'll probably earn something like 2%. Now, if you can, though, identify good, solid companies that are high growth potential companies, like Apple was back then, like Home Depot was back then, you're probably going to be in a better position. So let me say that again. If you can identify really good opportunities, again, the next leaders over the next 5, 10, 15 years, that will be the new market leaders with innovation, new technology, you'll very likely outperform a buy and hold strategy where you're just investing in the S&P 500. I should also note that I do think it's important that if Druckenmiller's right, in terms of the market will be flat, not only is it important to identify really good companies to invest in and very likely have a high concentration in those companies, but also if we get a go nowhere market where we just get a whole lot of ups and downs, having a strategy where you participate in the up portion of the market, in other words, the gains, and also the downtrends, there's some ways to do that. You may or may not be, aware of that. Most people have a traditional, let's call it a 60-40 portfolio with maybe some alternatives mixed in there, and they're buying and holding, and and over time, obviously the markets have generally done well. But when we're in a different period of time, coming out of a bull market, again, to the extent Druckenmiller's right, and there's a good chance he will be, you need to change your strategy. So to that end, if you would like a second opinion in your portfolio, this is our website. You can go on our website in the upper right-hand tab, click on that Contact Us tab, fill out the information, and one of our advisors will get to you and answer your questions and give you some clarity, ideally. Thanks again for watching. Have a great day. Bye-bye.